This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
Today on the show, I have Richard Weissman. He's a professional trader with over 25 years of experience. His most recent book is Trade Like a Casino, Find Your Edge, Manage Risk, and Win Like the House. I gotta love that. I'm a fan. I'm a fan of Vegas. I know there's a lot of bad things about Vegas, but I love aspects of Vegas. I don't gamble, but I do love the idea that smart guys can build things in the desert and make themselves a lot of money. I think that's cool. And I'm on the road right now in Virginia, and so that's been the slight delay in podcasts. I will have some monologues coming up and some more interviews before the year is over. But let's jump right into my conversation with Richard Weissman.
Hey, Mike.
Hey, Richard. How are you?
Good. How's the sound? Okay.
Yeah, I'm on the road, so I'm kind of adjusting here. Like you said, you were adjusting to the software. I'm kind of adjusting as well, but I think we're all good.
Good. I had tried it once when I was teaching in Singapore with my wife, and it worked pretty well then. So.
No, I think we're all good.
Good.
So let me ask. I know we must have connected. I know we were connected in Facebook and all that, but what turned you on to my world?
Well, I had heard of you through your books, and that's why I wasn't sure if I was a good fit for you because it seems like you're really into trend following, and of course it all depends on how you define the trend, but I consider myself more like a swing trader. So I hold like 2 to 10 days now, and also maybe trend trading has changed from the days when I entered in the 80s. But when I entered, it was like people that were holding things for months.
Well, I don't think the classic definition of trend following, at least by the way it's probably been defined back to Richard Donchi in the 1950s, has really changed much. So,
right.
But we'll definitely get in today because I want to give you full floor to convince people that 2 to 10 days is a workable solution. But the thing that I noticed right off the bat when we were exchanging notes was frankly a lot of your tone about risk management and positive expectation. I mean, those are classic trading precepts that, regardless of style, I think are foundational.
Absolutely, and that's the thing too, is that Schwager's work. I think that when I'm teaching traders, one of the things that I focus on is market wizards, just because he was so brilliant. He's interviewing all these different styles and hold times and philosophies of trading. They're all successful. They're all totally different in how they approach the market, and yet the one commonality is they're all excellent risk managers. They have tremendous discipline, confidence in their models because they've done their homework. So that's universal, I think, and obviously, that's a great point for us to connect on.
Yeah, when I think back to I don't remember every one of them by memory. I probably remember the ones that are trend following traders, and I've crossed especially the first 2 books. If I think back to the ones that were pure trend traders, your Richard Dennis's, your Ed Sekota's, your Larry Heit's, your Tom Basso's, your William Eckhart. And I think many people can make the argument, even though they might not have classified themselves that way. Actually, Bruce Kovner was in there, Michael Marcus, 2 other trend followers. But the ones that I was thinking of that might not have classified themselves that way would have been guys like Druckenmiller and Soros and Paul Tudor Jones. So a lot of big macro traders there. I actually, like I said, my memory shies me some on everybody. I guess I focused on the ones that were interesting to me.
Right. And, one of the things that I think, too, is that it all depends on how you define the trend. So if you define, my models, the things that they do have in terms of commonality, one of the things that was in my talking points was don't anticipate, just participate. So I'm not fighting the very short-term trend. I need evidence.
Mm-hmm.
The old Charles Dow theory of trading that that you want to buy markets that show signs of strength. So how do we define signs of strength? Well, higher highs and higher lows.
Yeah.
So I definitely need that. I'm not catching a falling knife in my work. Even if it just means that they take out the prior day's high, that is on a very short-term basis trend following.
Yeah. Before we jump into the nitty-gritty specifics, I want to go back in time and just maybe talk about historically. You've been in the markets for a long time, several decades, and maybe go back and map out your early experiences getting indoctrinated to the markets. I don't know, was it a teenager, a college? How did you work your way into trading?
Okay, so what happened was I graduated college, didn't know what the heck to do with my life, and my dad was an equities broker that specialized in equity options in Long Island, in Great Neck. And what he said was, well, why don't we go into business together and, you'll get a seat on the Amex and trade equity options. And so I went down there, and those seats, I forget what the heck they were going for. It was maybe $500,000 at the time. This is 1987. But one of the great things was that as I was wandering around down there, I met a friend of mine from high school. And he was, I forget which option he was trading. Especially this is going to be kind of recorded, so I don't want to tell you the wrong thing. But it was one of the big active ones, like Philip Morris or something like that. And I went up to him and said, "Hey, Alan, how you doing? What are you doing here?" And he said, "Well, I'm trading this." And I said, "God, $500,000, that's a lot of money. I don't have that." And he said, trading is trading. Go across the street over there, go over to the New York Futures Exchange. You could pick up a seat for $100. And then all you need is the capitalization requirement. I think at the time it was like 15 grand. And you're in business for basically 20 grand. Because I think the fees were maybe 1,500, semi-annually. Again, it's being recorded, so I don't want to tell you the wrong thing, but you're going back over 25 years now, so I don't really remember. But let's just say for 30 grand, I was in business. That was the good news, is that I was able to get in with very, very low capitalization. I wish I could tell you that, that it was a wonderful experience from the get-go, but the one thing that I really remember from, we're talking about the Schwager books and how great they were and how influential. The thing that I really related to in all the Schwager books was the Tom Basso interview where, he just got his head handed to him year after year and just kept going. The best thing for me was twofold, that I had very little capital, so I couldn't lose a lot of money. And second of all, even though I was losing and consistently lost for a long time, I was able to make contacts with people that were successful. And they took pity on me and helped to try and kind of get me up to speed quicker. I don't know that it did get me up to speed quicker. I think really the way you learn in this business is by losing money. Assuming you're a retail speculator. If you're working for a commercial entity or you're working on a desk for Shell or Goldman, maybe it's a different path. But as a retail speculator, I don't know. You meet a lot more people than I do, Mike. But for me,
I'm just a guy wandering the planet. I don't really know what's going on. I just try and occasionally plug in and see what's going on. Then I go off the grid. So.
Yeah. So I don't know anyone that started out retail and began just bringing in money and never looked back. But for me, it took me a long time. It took me a long time of losing money. And then slowly I started to lose less and less. And meanwhile, I kept reading and studying. And the main thing that really turned me around was the Larry Hite interview on Market Wizards and the 1% rule. And I just became a good risk manager until basically I was treading water. And I kept doing lots of back testing, lots of system development, and eventually started making money. So it was a long process for me.
You know, you've got 2 books to your name so far, and your most recent one was last fall, Trade Like a Casino, Find Your Edge, Manage Risk, and Win Like the House. It sounds like a good trend-following trader to my heart right there with a title like that. That's a good title. Tell me, though, about the idea of naming this book Trade Like a Casino, because for the uninitiated, and I just was in Vegas the other day, for the uninitiated, that when you walk through Vegas, you can look at the glitz and glam, and you can look at it one of 2 ways. You can say, wow, this kind of feels sleazy. I really know I'm not going to win. They're just here to take all my money. Or you can say to yourself, damn, Steve Wynn's a really smart freaking guy. Right?
Yeah.
I'm looking at the title of your book, and it's like, that's essentially you could say Trade Like a Casino, or it's be Steve Wynn, be Sheldon Adelson, be Donald Trump. Essentially that's what you're saying.
Absolutely what I'm saying. Yeah. That was one of the things that that first questions that I asked on the floor once I started realizing, hey, I'm losing, I don't know what I'm doing. So I went up to successful floor traders who weren't just making markets, who were using real speculative mechanisms, and I asked them, what can I model my behavior after? What industry? What's the model for this business, speculative trading that works? And the answer that I got was, there is no model. And so they're making money. I'm losing money. What do I know? So I just accepted it. But I never forgot my question. And then as I started to learn what successful speculative trading was, I realized 2 things. First of all, I realized why they didn't want to tell me what the parallel was, because already people think we're professional gamblers and we have a bad reputation, that there's no skill involved. But secondly, I realized that there was an archetypal industry model, and that's the gaming industry. So I like to tell people, a player walks into a casino. Is it possible that 2 hours later the player could walk out with more money than they walked in with? Of course. Otherwise, no one would ever walk into a casino. So why aren't the casinos shaking in their boots at that possibility? Because they know, no matter what game they choose, as long as it's in the casino, the odds probability is always skewed in favor of the house and always skewed against the player. So in the gaming industry, they call that the probability skew. In trading, we call it positive expectancy, which is not a cutesy way of saying you make money. It means after deducting for the overhead, the spread between the bid and the ask, and commissions, it still makes money. But even in the gaming industry, the probability skew is not enough. So let's say Bill Gates walks into that same casino. He's got a cashier's check for $1 billion. He walks over to the window and says, turn it all into chips. They will. But when he walks his wheelbarrow full of chips over to the roulette table and says, put it all on red, are they going to take that particular bet? The $1 billion bet on one spin? Probably not.
Yeah, I'll give you a great example. The other day, I'm in Virginia today, and I was coming from California. I stopped in Vegas to visit a friend, and as I stopped in to visit a friend, I actually was driving by the M Hotel, and I remember they had a really good spa, so I stopped in there and had someone give me the massage and beat the tar out of me. And this very nice woman who was beating the tar out of me told me that day, or the day before, somebody had pulled $11 million out of one slot pull out of the M Hotel. Wow. And I thought to myself, there's nobody happy in management right now. $11 million is a big hit.
It is. Yeah. So the idea is that the casinos recognize that if they allow the player to bet big enough, any single spin could ruin them. So what they do is they create table limits. So they say to the Bill Gates type guy, we'd love to take your $1 billion, but on a per spin basis, you can't bet more than 10,000 on a spin. So by forcing the player to bet smaller, it ensures that that probability skew is going to work itself out over time. So in the casino industry, they call that table limits, and in trading, we call it risk management. Now, in the gaming industry, that's really all you need. But unfortunately, in trading, there's a third element that you really don't need in the casino world. And to introduce that, I call it the analogy, the opaque urn. So there's this urn in the center of a room, and you can't see what's inside of it, but I'm telling you what's inside of it. There are 57 green balls and 43 red balls. Bet on a color. And of course, you bet green, out pops the first red ball. Well, now there's one less red ball. Bet on a color. And green, even more so, out pops the second red ball. Bet on a color. The third red ball pops out. And what behavioral psychologists tell us is that most human beings, after the third red ball, they say, this is not for me, and they decide to go on and become productive members of society. The disturbed individual will then say, wait a minute, I get it. There are no green balls. Bet on the red ball. And then the green ones come out. That's the problem. The problem is not that there are a lack of positive expectancy models. My first book was filled with positive expectancy models. No one cares. The problem is not that most people can't manage the risk, although this is where most people fall apart. The problem is very, very few people can keep the discipline to betting on their positive expectancy model when the losses come in clusters.
Yeah.
So that's
well. If you think about it, it's and I talk to people all the time, and most people think when they come to the markets that now that they've made the decision to enter with whatever strategy they have, that somehow or another, magically, the markets are ready for them. They're ready for the markets, and now it's just time to start, and everything's going to happen. Whereas it just doesn't work that way, and you're just a fly in the ointment of this big machine, and you've got to go the direction the machine is going, and if you don't, you're going to lose, and occasionally there's going to be periods of ups and downs, and you're not going to make money every month. At least, you might try and argue that to me. I'll argue back, but I think that's a really tough thing for people to do, is to have that mentality where there's going to be no losses.
Yeah, no, you have to prepare yourself for losses, no matter how robust your method. That's the thing. One of the things that I talk about in the second book is the three things that you can guarantee. So the three things you can guarantee are uncertainty. So because you never know whether the next tick is an uptick or a downtick, unless you force it to be an uptick by, hitting the ask. Other than that, you're absolutely uncertain. Because you can't be certain, you have to manage the risk every time. You have to always assume that the next trade is a loss, even though even a model that makes money on 90% of its trades, 90% wins, huge positive expectancy model, you have to still be a pessimist and say every trade is going to be a loser. Okay, but
the 90% you just mentioned, though, that's just the percentage of wins. If the percentage of if the return on that 90% is pennies on the dollar, but your losses in the other 10%. So you might want to actually go into that and kind of go through the idea of an expectancy formula, because the size of the winners and losers is going to be the ultimate measuring stick too, as well, right?
Yeah, of course. I mean, the way that I break it down is that I say that in trading, everyone has to swallow poison. The only good thing is you get to choose which kind of poison you're going to swallow. So long-term trend following, we call that poison death by 1,000 paper cuts. So paper cut's not so bad, but you take paper cut after paper cut. After a while, you start getting sick of it. So if you can't sustain these little losses over and over again, then you're not going to be able to survive as a long-term trend follower. The opposite end of that spectrum we call picking up pennies in front of a steamroller. So now you're going to have that wonderful feeling. Everyone likes to win too. You're going to have that wonderful feeling every day. You pick up the pennies over and over, day after day. It's just this wonderful thing. Every day you're winning until one day your sleeve gets caught and you get rolled over, and you give up 6 months of profits in a single day. And you have to start all over again from scratch. And you're only picking up pennies. That is, there's lots of iterations of it.
I wonder what percentage of the population, given those two choices, I think the vast majority of people would still try and pick up pennies in front of the steamroller.
Yeah, and the interesting thing is that I've met traders that are successful in both camps. It's not like one works and one doesn't. As long as you're really good as a risk manager, you can make money doing anything. I'm pretty convinced that really, really strong, robust risk managers, they can pretty much do anything because it's just a matter of style at that point. Personalities, I think most people do like to win.
Yeah.
And what I've found from my personality, I'm kind of in between those two extremes. So if we kind of go into a little more detail, so long-term trend following, what you'll see is that maybe the winning percent is 30% wins, maybe 40%, maybe 45%. But the average profit to average loss, that ratio can be very, very high, like a 4-to-1. So every time that you win, you get $4, and every time you lose $1. So that's positive expectancy. The picking up pennies in front of the steamroller crowd, so there they could have 90% wins, but the average profit to average loss, maybe every time that they win, they get 15 cents, and every time that they lose $1.
Yeah.
So it's still positive expectancy, but you have to have the kind of the tenacity to keep going after you give back 6 months of profits in a single trade. Like I said, it's all poison. There's no easy way to make money out there.
Well, the funny thing though is as you say that, is that the one thing we're talking about active, not necessarily only meaning active in terms of like lots of trades, but just the idea of actively speculating. We're talking about actively speculating. And I think sometimes when I hear people like myself, yourself, it somewhat becomes defensive because the other side of the coin is the mutual fund world. It's just where the vast majority of assets are. And nobody ever hangs the scarlet letter, so to speak, on the mutual fund world. It's just kind of like everyone's in it. And even though there's been 2 S&P drops of more than 50% in the last decade, even though for anybody that was paying attention in the fall of 2008, and I'm not taking away anything from Mr. Buffett's performance, but clearly there was a lot more going on in the fall of 2008 with Mr. Buffett beyond just value investing. I mean, there was a lot of phone calls to the president, a lot of phone calls to Goldman Sachs, and a lot of stuff that you and I don't have the ability to do to access to make money. That's his business. But I just think sometimes that, as we're talking about these two different styles, picking up pennies in front of the steamroller or a trend trading strategy, we sometimes talk about the difficulty in them. But then again, for the vast majority of people, and a lot of people listening to this conversation today might not yet be either of those styles that you and I are talking about. But I think it's worth noting to them, and I'll let you run with this, it's worth noting to them that the current style they might be in the middle of might not be so safe either. As we talk about the negatives, honestly, about what we're involved in, I just want people to also be thinking about the negatives of index funds and mutual funds and value. You know what I mean?
Oh, yeah. Oh, yeah. I mean, the irony is people say, futures, that's really risky. Well, keeping your money under the mattress is risky too.
Yeah.
Earning a real negative interest rate on your savings account is risky as well. So you have the risk of not taking the risk. Given those opportunities, I'm always going to take the risk. So, I mean, I am always kind of a pessimist, and I tend to paint a negative picture. I have some friends and I manage their money, and they say, "What can I expect?" I say, "You can expect to lose all your money." But I do that just because you never it's like the ocean. You never want to turn your back on it. You never want to be complacent about risk. But no, people, the other side of the coin is people say, so what do you do with your safe money? I say, I have no safe money. Everything is in futures because I know that my models work. And putting it into some quote unquote safe investment where I quote unquote couldn't lose it, that to me is so counterintuitive. I've spent decades developing these tools and techniques, and I know I can outperform, anything out there. Why would I squander those resources and my capital on something that I know is suboptimal? I wouldn't.
You make my point when you say that someone says, where do you put your safe money? And the assumption being that there is such a thing and that they're currently doing it and that you're currently doing something that's unsafe compared to them, whereas they're in the strategy that has gone down 50% twice in the last decade. And if anybody takes a look at Japan for the last 30 years, if you want to be a buy and hold guy, that might be the closest analogy as to where U.S. markets will eventually be headed if buy and hold is your only strategy.
Right. I mean, when people start talking about that stuff, I always mention to them, well, if you were buy and hold in 1929, you took until 1954 to break even.
Yeah.
So that's not so good. Look, in certain environments, in a rip-roaring bull market, you buy and hold in 82, you look like a genius up until 99.
There you go.
But that has to do with the trend of the market. That doesn't have to do with the investment vehicle in a vacuum.
Yeah. You had some when we were exchanging emails, you had some great one-liners that I just wanted to let you run with. I thought these were all kind of, I think people would enjoy these. The one that caught my eye this morning also, or a bunch of them, but don't tug at green shoots.
Yeah, this is one of the things that I think most people do. The work of Kahneman and Tversky in prospect theory, they say that we all like to take small profits and big losses. So what's successful trading? It's the exact opposite. It's big profits and small losses. So you put on a trade. It goes against you. Nothing you can do about that. Just manage the risk. Go on to the next trade. But I think one of the big problems that traders have is that they put on a trade, it goes in their favor, and then suddenly they're like, oh, I got to get out of this thing. I got to profit. This thing could turn around, etc. And before you know it, they've realized a gain of 50 cents in crude, only to watch crude move $10 more in the favor of the trade that they initiated, just because they weren't willing to let the trade pan out. In other words, you don't exit until there's a reason to exit, and a reason is not I'm making too much money. That's you putting an artificial constraint on the market's dynamics. That's you saying, oh, no, don't give me too much money because I'm afraid. I'm afraid of the uncertainty, and I'm afraid of the fact that maybe it's going to come right back in my face. But, the market is going, I'll give you a great example. 2008, natural gas starts dropping from $15 per MMBTU. And in a couple of months, it's dropped to, or maybe even in 8 days, it's dropped to $14 per MMBTU. And you say, wow, that's $1 per MMBTU. That's a lot of money. $10,000 in whatever it was, I forget exactly, but 2 weeks is a lot of money. I got to get out. What I'd like to suggest is the market's going to go from 15 to $1.90. It's going to go another, $12. The only question is, or $13. The only question is, are you coming along for the ride? $12. And that's tugging on green shoes. That's putting an artificial mechanism that cuts your profits. So don't cut the profits, cut the losses, but let the profits run and let the market determine when it stops going down or up.
Okay, so you got one here. This one looks a little controversial to me, and I'm going to let you run with it too, let you explain it to us. You have another one of your trading, what do you call them, rules or precepts, but
Yep.
Always trade value, never trade price.
Exactly. Yeah. So, okay, here's the scenario. There's this asset out there, and it's at all-time new highs. It's never traded this high in its entire history. You look back, you go hundreds of years back, you've never seen anything like this. You look back on a chart and you just see so it's over 1,000. You see 6 months ago it was trading at 775. Say, you know what? Let me put a limit order. I'll buy at 775. That way I'll have less risk. I'll still participate in this bull trend, but I'll have less risk, more reward. And I'm telling you, in 1982, the Dow Jones Industrial Average made an all-time new high of 1,068.2. We've been through the Great Recession, credit crisis, you name it. Never got anywhere near there. So an asset can simultaneously be at all-time new highs and still be undervalued. It's what I like to call the blue sky phenomena. There is no resistance. Nobody knows where the heck the thing is going. So if you are caught up on price, then you have no frame of reference, which is kind of why I like to augment technicals with fundamentals. Not in a kind of
blasphemy.
not in a follow the news type of way, but saying, hey, look, something's going on in the market that price doesn't have any answer towards. So, crude oil in 2004, it breaks all-time new highs, $42 a barrel. There is no resistance. So, me getting out because the price is too high, that doesn't make any sense. I should be buying more because there is no resistance. There is no price history. So that's what I mean about value as opposed to price. Right. So don't let a high price stop you from buying. Don't let a low price stop you from selling.
What's motivated me in my world, and I'm not oblivious to the fact that there are people out there that use fundamentals to great success. I'm not oblivious to that point. For me, though, I look at the world and I say, gee, for the average person, and I think this also gets back to one of my original influences, which was the turtle story. For the average person, it seems like if they're coming into this fresh, that wrapping your arms around, and I'm not necessarily saying this is for everybody, because some people might not be able to adjust towards the death of 1,000 paper cuts, but it's seemingly much more digestible for me to look at a trend following strategy via price and say, oh, okay, I can trade this. Whereas it seems like, and I remember back early in the day, and I was reading, who was he? Was one of the guys. Oh gosh, what was his name? Oh, anyways, the one book, Seth Klarman's Margin of Safety, Jim Rogers' Investment Biker. I remember reading those books and thinking to myself, how am I going to take in all of this fundamental data to make good decisions, and how am I going to compete against all of these superstars? And then when I started to get into this world of the quant trend following world, I was like, oh, this gives me a way to compete without having that expertise. And that's always been kind of my mentality. Not that I think that fundamentals are impossible. It's just very difficult, at least from my perspective.
Yeah. So here's the way that I would say it, is that, and people always ask me, do you trade fundamentals or technicals? And I say, yes, I do. I trade everything. I will probably admit to the fact that certainly my risk criteria is technically driven. There's no fundamentals in the risk criteria.
It's math. It's math, cut and dry. I mean, it's just like any other great trend following trader. I mean, I look at your when you're talking risk management, expectancy. I mean, you're talking near and dear to me.
Yep, and entry is always price driven too, because I don't anticipate, I just participate. I need the price to take out some kind of resistance, even if it's just the prior day's high.
You're sounding more and more like a trend follower there.
Yeah,
you're sounding more and more like a trend follower. Keep going.
Well, but it depends on how you define it. So if the long-term 6-month trend is down, but you take out the prior day's high, I'm still interested potentially. Not necessarily, but potentially. So the short-term trend, definitely I'm with the short-term trend. And then the The other things, so management of the trade, taking partial profits, it's all technically driven. So it kind of makes you think, well, this guy is just technically driven trend trader. It's got all the bells and whistles of everything that is traditionally spoken of. But there are certain elements where fundamentals will enable me to press heavier or tread lighter.
Well, give an example of that so someone can wrap their arms around that, because it can sound very subjective, and of course I think using fundamentals to some degree, unless you're using a strictly quant system, is going to have a certain element of subjectivity into it. So why don't you give people an example of how you might use fundamentals?
Okay, so for example, when Bernanke came out with his QE3 announcement, the indices make like significant highs on that day. The stock index futures make significant highs on that day. Incredibly bullish news for physical assets. And as if that weren't bad enough, there's trouble in the Middle East. I don't know if you remember, but there was stuff going on with Syria and Palestine, the Palestinians and Israel. So it's the perfect storm for crude to go up. Crude ends up, and crude's intraday does actually make a little bit of progress, but it ends up lower. That's not enough for me to go short. But when it takes out the lows of the prior day, now I'm short. Because first of all, the market's proven that it's the path of least resistance, at least short term, is to the downside. And it's on bad news, and it's on good news. The market's going down on good news. That can't be good. That means that somebody out there that knows more than I do wants to sell. So that's how I would combine the fundamentals with the technicals.
Gotcha. Yeah. Well, let me jump in another one of these bullets that you have, which I kind of wanted to let you run with too, because I guess I've seen this said in slightly different ways. But you have trade the market, not the money.
Mm-hmm. Yep. So I like to say that we're all in this business to make money, but if you focus on the money, you don't get the money. The money is poison. Focus on the process. Focus on risk management. Focus on your method that enjoys positive expectancy, and you'll have more money than you know what to do with. And all the nonprofits will love you. You'll be their best friend. But if you focus on the money never comes, because you're going to be focusing on the $10,000 is a lot of money. You know, the nat gas going down $1, you got to get out because you're making too much money. Or you're looking at, I need to make a certain amount because my bills come in a nice, orderly monthly fashion. So I need to make this much every day. I need to make this much every month. Well, unfortunately, profits and losses don't come that way. The market is going to give what the market's going to give. You follow your rules. You take what the market's going to give you. I think in Trade Like a Casino, I have this like quote from Huey Lewis in the News. You know, working for a living, you're taking what they're giving. You can't take what the market's not willing to give. Sometimes the market's only going to give you $100. Other times, the market's going to give you $80,000. You never know which it's going to give you ahead of time. You have to take every trade, and whatever the market gives, that's what the market gives. Trade the dynamics of the market, not the money.
Yeah, you know, it is a really tough concept for people to understand, because whether they're I think what happens is, and I make this argument on my blog all the time, and I try and get people to understand some of these non-financial authors, people like Seth Godin or Tim Ferriss, is that to be a good trader, to be a good investor, you really have to think like an entrepreneur. You can't think like especially if you've grown up just working for the man, or you've got a steady salary, or you have a steady job. You really don't want to apply that type of thinking to your investing. And I think most people do, but it's just not the way the world works. You really, even if, and you know, I would try and persuade anybody to quit their job today. I don't care what you're doing. If you're working for the man and you're not really happy with it, quit and do something else. You only live once. However, if you are going to stay within that structure, it probably makes a lot of sense, and we can go into this now if you want to, some of the psychology of all this. It probably makes sense to really figure out a way to get your investment world to be a little more entrepreneurial.
Yeah. I mean, you know, first of all, I totally agree. I think life is way too short to be unhappy. There's enough unhappiness just embedded into this, human body. We all get sick and die. So in the meantime, why not enjoy what you're going to be doing for 8 to 10 hours a day, whatever that is. And you have to find the joy in the pain if you're going to be a speculator. So, if it's research that brings you the joy and you like the process of solving puzzles, then that's going to keep you sustained when the money is shallow and when the money's not there, when you go through a drawdown. If it's the psychology and liking the process of dampening emotionalism, and that's going to sustain you as a motivating factor in this business, then that's a good reason. So whatever it is, you've got to find the joy in this business. Otherwise, don't do it.
Well, you sound like a pretty optimistic guy. We haven't talked before. You got that kind of good, alive thing in your voice. Don't sound like a downbeat guy. So why don't you talk about the psychology, and maybe if you've got any tips or tricks on how to navigate this world of trying to make money in the markets. For people out there that are feeling stressed out, and they look at the markets and they say, "Oh, I'm ready to start trading right now, and I have to make money right now." They lose the first day, and then they're panicking. And why don't you talk a little bit about the psychology of your thought process?
Okay, so I actually came up with various tools that have helped me throughout the years. So a lot of these are just things that I repeat, and I still do this every day. So one of the things that I repeat is the next 10,000 trades. That after a loss, I say to myself, I'm looking at the next 10,000 trades. This particular trade is one data point. It means nothing. It's the next 10,000 data points. That's what I'm trading for. And if you look at your losses that way, then suddenly the emotional sting really begins to become dampened. Now, the other side is that you have this home run trade and the emotional euphoria becomes a little dampened too. But I think that is a healthier way to live. I actually listened to your interview with Tom Basso, and I think he was saying something like this too, that you kind of smooth out the emotional highs and lows and you're much happier as a trader. So that's one thing that I work at. And now another thing, this is really, really useful. Some of the most useful tools that I've come up with in trading came from the repetition of this phrase. You got to do both parts of it. You can't just do one part. So the phrase in its entirety is, you ask yourself every day, how can I simultaneously risk less and make more? Mind is creative. If you keep saying that day after day, it's going to sound ridiculous in the first week that you do it. But you do this day after day, month after month, you become really creative. You start looking at charts differently. And you keep asking this open-ended question, answers start coming. And I developed a lot of techniques just by asking myself that question over and over again. Because that's what successful trading is. Cutting off the loss tail of the distribution, letting the profit tail run. And if you keep forcing yourself with these questions, good things start happening. So yeah, next 10,000 trades.
Well, you're getting it. You're getting at the statistical thinking. And I posted something on Facebook just randomly the other day. I got something, I think it was from Opal-esque or something, this hedge fund monitoring operation. And it said something to the effect that, what have we learned in the last 9 months of market behavior? And so I posted it on my Facebook. I said, well, is there really anything that can be learned from any one window of 9 months alone of market behavior? That's all you have is some 9, and you're going to try and develop a strategy on 9 months alone of market behavior. And I don't think some of the people that were posting on my Facebook kind of got where I was going at, but if we follow your line of thinking where you're talking about statistically significant issues, 9 months alone, picked at random for, let's say, some index or whatnot, tells you absolutely nothing. You can't develop a trading strategy off 9 months of data. It's just not enough. It was interesting to watch people struggle with where I was trying to push them to, and it was really kind of a psychological block to a proper statistical thinking.
Right. Yeah. Yeah. I do a lot of that type of work in my back testing and research. Is that I'll go back 30 years, 40 years for some assets, and then I'll look at assets that have nothing to do with each other. So, like, sugar in the S&P. That way, if it's robust on both of those, you might actually have something going back 30 years. And then different time frames too. So if it's just real simple stuff. If it's a 926 moving average crossover, okay, so that works on a daily chart. How does it work if it's if it's a 5-minute chart? Now, I wouldn't expect it to work exactly the same, but the logic of very robust methodologies do work on multiple time frames.
Yeah. Hey, Richard, I've got one more question I'm going to throw at you, but I want to make sure I get it in here. What's the best way for people to reach out and contact you and get a hold of you? What's your main website where they can go?
Mm-hmm. So I have this for lack of a better term, newsletter that they could get my contact information from, which is www.weissmansignals, WEISSMANSIGNALS.com. And from there, there's a lot of educational links there to different webinars I've done for different entities, and there's links to the Amazon for the book and all that type of stuff. So a lot of stuff.
So, actually, there might be two more things I'm going to go at. But
Okay.
One of the things you also mentioned, I want to let you clarify this too, because I wasn't necessarily sure where you were going with this. You had a point where you said drawdowns are for under-leveraged trading and research. Why don't you clarify what you mean there?
Okay, so first of all, measuring peak to valley drawdown. So people always talk about losses. I talk about losses in this interview. I've talked about losses. But really, losses don't mean anything. What we're interested in terms of determining the robustness of a methodology is measuring from an equity peak in performance to an equity drawdown, a valley in performance. And we call that peak to valley equity drawdown. So that's how we measure, how bad a successful model can be in terms of what we're going to have to endure to get the money from this model. So when you're experiencing a drawdown, the tendency, human nature, is to fight your way out of it. So I'm losing, so I'm going to double my bet size, and that way if I have one winning trade, I can get out of this drawdown and get to new equity highs. Instead, that type of emotionalism is counterintuitive to positive expectancy and to successful trading. So when you're experiencing this shallow period in the model, the answer is to trade less, to trade smaller. So we talk about 1% of assets under management on any particular trading idea. That's your ceiling in terms of risk. But when things aren't going well, there's nothing that it prevents you from doing less.
Yeah.
So go all the way down to one tenth of 1%.
Yeah.
So
and that's also just to share with the audience. That's classical trend following risk management as well.
Mm-hmm. So under leverage trading, I'll bring it all the way down to 1/10 of 1%.
Gotcha.
And then people will say, well, what's the point? You might as well just be paper trading at that point. I've done both, and I will tell you there is a difference. Under leverage trading, you still do experience the emotional pain of a loss. Even though the money doesn't mean anything anymore, you're still feeling it. And you're still feeling, wow, that's my model, it should be winning, and it's another loss, and the emotions are still there. When it's paper trading, a lot of that goes away. And I'm not saying, Mike, to your audience that they shouldn't paper trade, especially when they're starting. But I'm saying when you are live, taking it off the table entirely and going to paper trading, it doesn't work. You do need to have skin in the game to feel those emotions in order to come out the other side and get to new equity highs.
I think that's a great point, and probably even this like I can't keep I find with these conversations it's amazing, and you fall right into the camp of most of these really quality folks that I've spoken with. it's so fun and interesting for me just to hear people's different perspectives. And there's such a huge commonality in almost everyone that I've talked to. And maybe the biggest commonality is just to think outside the box a little. I mean, just to not accept everything at face value, to try and be like, you know what, I'm not going to just do everything like my neighbors. And I hear that in your voice too. But let me give a wrap here though, so I can let people know where they can once again they can find you, Richard, at Weissman Signals, WEISSMAN Signals.com, and your most recent book, Trade Like a Casino. That was from Wiley as well.
Mm-hmm. Yeah, Wiley.
Trade like a casino, find your edge, manage risk, and win like the house. And everyone should definitely take a peek. And so, Richard, hopefully we can talk again in the new year. I might be on funny time frames because I think I'm going to be spending most of my new year in Asia. So who knows where I'm going to be in terms of scheduling podcasts. But I can't stop now. I've done like 100 of these things, so it's in my blood. So, but I appreciate you joining me today.
Me too, Mike. I really, I'm glad that you wanted to do this. I know I'm not your typical interview, but I think a lot of the commonalities are still there for your audience.
Oh, they're definitely there. I mean, when we started exchanging notes, I was like, that was, and like I said, come on, trade like a casino. It might as well be like trade like Steve Wynn, trade like Sheldon Adelson. And I mean, and people could say what they want about casinos. I think, Ben, that except for blood, guts, and some capital, can build hotels in deserts and make billions of dollars from themselves. People can hate them till the cows come home. I don't hate them. I think they're awesome. That's my personal view. So, anyways, Richard, we'll talk again soon. I thank you for joining me today.
Thank you, Mike.
Okay.
Take care.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.